Warren Buffett put $35 billion into a single stock. Not a fund. Not a basket. One ticker. And the reason he did it has almost nothing to do with technology. There's something buried inside this position that most analysts completely missed. They looked at the hardware. They looked at the iPhone cycle. They got it wrong. By the end of this video, you'll see exactly what Buffett saw when he pulled the trigger on Apple, and what it could mean for your portfolio right now. Let's start with the raw number, because it's staggering. $35 billion. That's not a toe in the water. That's not a hedge. At its peak, Apple represented over 40% of Berkshire Hathaway's entire public equity portfolio. 40 cents of every dollar Buffett had in the market was sitting in one company. For a man who built his entire reputation on diversification and margin of safety, that's not just a position. That's a conviction bet. Now, here's where it gets interesting. Buffett started buying Apple in Q1 2016. The stock had just dropped nearly 30% from its highs. Analysts were writing eulogies. Peak iPhone. China risk. Innovation drought. The narrative was ugly. And while retail investors were hitting the sell button, Berkshire was quietly accumulating one of the largest stock positions in its 60-year history. Can you guess what the market thought about Apple at that exact moment? Sentiment was near rock bottom. But Buffett wasn't looking at sentiment. He never does. Here's what he was actually looking at. Switching costs. Think about how many people you know who've switched from iPhone to Android in the last 5 years. Now think about why they didn't. It's not just the hardware. It's the iMessage ecosystem. It's the AirPods paired seamlessly. It's the Apple Watch. It's years of photos stored in iCloud. It's muscle memory and social signaling baked into a single device. Buffett called it a sticky product. That's an understatement. Apple doesn't just sell phones. It sells a lifestyle lock-in that compounds year after year. And here's the number that made Buffett's eyes light up. Apple's customer retention rate hovers consistently above 90%. 90%. Compare that to the average Fortune 500 company, where customer churn is an existential threat every single quarter. Apple doesn't have a customer acquisition problem. It has a customer retention machine. And that machine prints cash. Speaking of cash, let's talk about the balance sheet, because this is where the real story lives. At peak cash reserves, Apple was sitting on over $200 billion in cash and marketable securities. $200 billion. That's larger than the GDP of most countries. And what does Apple do with that cash? It buys back its own stock. Relentlessly. Systematically. At a scale that should make every retail investor pay attention. Between 2013 and 2023, Apple returned over $600 billion to shareholders through buybacks and dividends. $600 billion. That's more than the current market cap of JP Morgan Chase. Every year, the share count shrinks. Every year, your slice of the pie gets a little bigger, without you doing a single thing. Buffett understood this better than anyone. He's called it a very smart thing to do when a company is buying back shares below intrinsic value. But here's the angle most people miss entirely. Apple is no longer just a hardware company. Services revenue, the App Store, Apple Music, iCloud, Apple TV Plus, Apple Pay, crossed $85 billion annually. That number is growing at double digits while iPhone growth has slowed. And here's why that matters for your portfolio. Services carry gross margins north of 70%. Hardware margins sit around 36%. When Buffett bought Apple, services were a rounding error. Today, they're the engine. He essentially got a high-margin subscription business free inside a hardware company everyone was undervaluing. That's not luck. That's pattern recognition at the highest level. But here's what could make this entire thesis wrong. And I need you to hear this clearly. Regulatory risk. It's not theoretical anymore. The Department of Justice filed an antitrust lawsuit against Apple in March 2024, targeting the iPhone's ecosystem lock-in, the exact competitive moat that made Buffett fall in love with the stock in the first place. The EU has already forced Apple to open up to third-party app stores under the Digital Markets Act. If regulators successfully break open the walled garden, the service's revenue model, the 70% margin machine, takes a direct hit. And that's not the only threat. China represented roughly 19% of Apple's total revenue in recent fiscal years. That's not a rounding error. That's a strategic dependency. US-China tensions, export restrictions, and Huawei's aggressive domestic resurgence have already put pressure on Apple's market share in the world's largest smartphone market. A sustained decoupling scenario doesn't just dent the top line. It craters the growth story that justifies a premium valuation multiple. Here's the uncomfortable truth. Buffett himself began trimming the Apple position in 2024. Berkshire sold a significant chunk. Not all, but enough to raise eyebrows on Wall Street. Was it tax planning ahead of potential capital gains rate hikes? Was it a valuation call? Or did Buffett see something in the competitive landscape that warranted caution? He hasn't given a straight answer. And that ambiguity should sharpen your focus, not dull it. The bull case is powerful. The bear case is real. Both can be true at the same time. So where does that leave you? Here's the honest verdict. Buffett's Apple position was never really a tech bet. It was a consumer behavior bet. It was a bet that hundreds of millions of people would continue choosing the path of least resistance, staying inside a closed system they already paid to enter. That bet has paid off spectacularly. The $35 billion position generated returns that fundamentally changed Berkshire's trajectory. But the next chapter is more complicated. Apple in 2016 was a misunderstood consumer staples company wearing a tech company's clothes. Apple today is a fully priced, institutionally owned, regulatory targeted giant with meaningful exposure to geopolitical risk. The moat is real. The headwinds are also real. The question every investor needs to answer isn't, is Apple a good company? Quote, it obviously is. The question is, at what price does even a great company become a bad investment? Quote, and here's the unresolved thread I want to leave you with. Berkshire's 2024 trimming of Apple coincided almost exactly with a surge in their cash reserves. Berkshire's cash pile hit a record $277 billion by late 2024. That's not money sitting idle. That's a war chest. Buffett is waiting for something. What does he see coming that most of us don't? That answer could be the most important signal in markets right now. Apple is a 40% position turned into a case study. The real trade might be figuring out what Buffett is building toward, not what he's walking away from. Buffett didn't sell Apple because it's broken. He trimmed it because something better is coming. Agree or disagree? Drop your take in the comments. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions. Portfolio Intel does not hold positions in any securities mentioned at the time of publication.